Good morning and welcome to Financial Accounting. Today is day 10 for the fall 2022 semester. And we're going to be working on chapter 5 today. So if you haven't already opened them, please go ahead and log in to see now and get the chapter 5 exercises open. We're going to get started with those right away because we did do a very brief introduction to the chapter at the end of class on Tuesday, just to get us started. Looking at our calendar, at least we can see the next couple things that are due. So we finished chapter 4 on Tuesday. So the chapter 4 problem is due today by the end of the day. And we talked about on Tuesday that that's the comprehensive problem. So it's a little bit more involved, covers everything in those first 4 chapters, and it does carry a little bit more weight toward your final grade than a regular chapter problem does. And then because we officially were starting chapter 5 today, according to the syllabus, the chapter 5 pre-quiz should be in by the end of the day today as well. As always, you need to get a 60% to get full credit for that. There's no additional credit towards your grade for continuing to improve your grade beyond that 60%. However, for some of you, that might be helpful to keep trying until you get them right. It's up to you. I can see, but I don't intentionally go in to look at your grades on those. I just look at, did you pass or not? So we'll be picking up today with exercise 1 in chapter 5. We had talked about the first couple steps, but then ran out of time on Tuesday. So we'll just pick up from the beginning and briefly or quickly do the first couple steps as review. Those of you who were here on Tuesday should already have those completed and saved. And then we'll finish up chapter 5 on Tuesday. So the chapter 5 exercises would be due on Tuesday, chapter 5 problem on Thursday. And looking a little bit down the road, then we'll be starting chapter 6 next Thursday. And chapter 6, believe it or not, is the third and final chapter on exam 2. So exam 2 is coming up in just a couple weeks. And we knew that, starting this semester, we have 5 exams in 15 weeks. So that means you're having an exam about every 3 weeks, of course. Exam 2, just looking ahead, is due October 9th, Sunday, October 9th. Just like with the first exam that you just took this past weekend, the exam period officially is Thursday through Sunday. You could take it at any time after you finish the work for chapter 6. And the reason I'm really mentioning this today is I'm looking ahead in my calendar and wanting to schedule a review session, assuming that you find that beneficial. So what I'm asking is if you like the idea of the review session, if you were able to attend the one we had last week, or if you wished you could have attended, but it was maybe in conflict with something else in your schedule, I would ask that you just send me an email and let me know, I'm interested in coming. Here's a couple times that would work for my schedule. And as much as I can, I will work around that to get a review session scheduled. We had the one last week on Friday morning. Maybe that doesn't work for people's other class schedules. So or something else you have going on. So if you're interested in attending, just send me a note and say, hey, I'd like to attend. Here are some open times that would work. And if I can, I will meet the needs of the majority of people who let me know. Otherwise, if you don't attend, as long as anyone attends and we have a review session, I will record it and make that recording available, just as I did last week. So any questions before we get started with chapter 5, exercise 1? Okay. So I realized after class that there was something that I should have mentioned. And so I'm just going to pop the learning objectives back up on the screen for a moment. So one thing that I should have, if we had more time, covered, just mentioned briefly, is what you see on this slide. It's objective 7, Now, I know I told you we don't cover the appendices, and that's definitely true. We do not really cover the appendices. However, it is important that you recognize the difference between what's mentioned in this learning objective of the periodic inventory system compared to the perpetual inventory system. So the perpetual inventory system means that, well, let me ask you, what does it mean if something's perpetual? What does it mean if something's perpetual? No physics people in here, heard of perpetual motion? People are constantly trying to come up with a perpetual motion clock. No? Okay. Perpetual means it's ongoing, it keeps happening, it's constant. So a perpetual motion clock means it never stops, it doesn't need a battery, it doesn't need to be wound. Basically, the idea of the perpetual motion clock is that it powers itself. I saw a meme the other day of someone who had created a device to attach to the wheel of his electric vehicle, and that device was taking the energy produced by the wheel as it turned, as the car was driving, and capturing that energy and using that energy to charge the battery in his car or her car, I don't know. And so I thought that was really ingenious. So we're trying to use the energy rather than having it dissipated into the environment or whatever. Take something that already exists. It's kind of like having a power station at Niagara Falls. The water is going to keep falling anyway. We might as well capture the energy of that water falling to produce electricity. So at any rate, perpetual means it's constant. It doesn't have anything, in this case, it doesn't have anything to do with electricity or creating energy. But if something's perpetual, it means it's constant. It's always happening. We contrast that with what's mentioned in the Appendix 2 learning objective, the periodic inventory system. So if something happens periodically, that means it just happens every once in a while, right? So I assume even if you don't know the word perpetual, you're familiar with that word. You know what a period is in terms of the school day. So in high school, you have whatever, 7, 8, 9, 10 periods during the day, and you have class periodically. A periodic inventory system has the same concept to it. It means that we only update the records periodically. And from an accounting standpoint, if something happens periodically, it generally means it happens once a month. So if we use a periodic inventory system, we update it only once a month. If we use a perpetual inventory system, we're constantly updating that. Every time we make a purchase, we have more inventory, we update the record to show that. Every time we make a sale, we update the record to show we don't have that inventory anymore. If a customer returns something to us and we're going to put it back on the shelf and have it available for sale again, we would add that back to the inventory as well. And so what we are going to be looking at for the most part in this chapter is the idea that our company uses a perpetual inventory system. We're constantly updating it every time there's a transaction. That's what we're going to be seeing in these exercises. But there are absolutely companies who still use periodic inventory systems. Traditionally, traditionally up until maybe even 20 years ago or sooner than that, more recently than that, there were many companies who used periodic inventory systems because they sold product that was maybe small value, low ticket items, and it just wasn't worth it to try to track the inventory on a real-time basis. With the proliferation, the availability of computing technology, the idea of barcodes and scanning became much more affordable, even for small companies that were selling a lot of small ticket items. You know, even if you go into a Dollar Tree now, where everything's $1, they're now using a scanning system, where that was not the case, you know, even 15 years ago, 10 years ago. If you went into a Dollar Tree, do you have Dollar Trees here in Jamestown? Does everyone know? Are they really? It's been a lot of years since I've been in the Dollar Tree. I used to, and see, now I've got a problem with Dollar Tree because I used to like the Dollar Tree because everything was $1, or maybe some things were 2 or 3 for $1 if they were small. And then when Dollar General started getting big, I was very disappointed to see that things weren't actually $1 there. But 15 years ago, when you went into the Dollar Tree, and at the time everything was actually $1, if you took a cart full of stuff up to the counter, they did not use a scanner and scan the barcode on every single item. This is how they rang up or checked out your order. You put everything on the counter and they just opened a bag and started counting 1, 2, 3, 4, 5. And certainly they had to keep the taxable from the non-taxable items. But beyond that, they didn't keep any kind of a real-time record of what you purchased. Your receipt would say 20 taxable items at $1 and 14 non-taxable items at $1. They were not keeping track of it, but now they do. And the reason they do that is because they can, because it's cheaper, it's more affordable, and it does give them better information about tracking their actual inventory, the sales of the actual items. It can help in the ordering process, because if your accounting records are up to date, you can look in the records to see how many of those items do we have? Should we order more? Computers also allow you to set order points, so it will automatically trigger an order, or at least throw a flag so that someone who's placing an order would say, oh, wait, our inventory shows that we only have 4 of those left. I guess we better buy some more. Where again, 15 years ago, they didn't use that technology. It's not that the technology wasn't available, but it wasn't affordable enough to make it worth it for a store like the Dollar Tree to use. And now they do. So just wanted to mention that, talk about a little bit the difference between perpetual and periodic systems. I'm not saying that the concept of a periodic system might not come up again. It certainly might, but the majority of companies today are going to use a perpetual system that is real-time inventory. Where 20 years ago, when I started teaching accounting, certainly when I was working in accounting, the only companies at that time that were using a perpetual inventory systems were companies that were selling larger, more expensive items like a car dealership. It was important for them to know which car they sold, because every car is different. There might be 3 Ford Explorers on the lot, but they're all different. They're all going to have different option packages and so on. And so a company like that, that's selling unique, one of a kind or high ticket items, would have been keeping track in real time, but a company like Dollar Tree definitely would not. So any questions before we go back to exercise 1 and pick up where we left off on Tuesday? Okay, so we had already done A and B together. So I'm just going to quickly do those in particular for the benefit of people who may not have been here on Tuesday. In this exercise, we are Lilly Heating and Air Company. These are purchase related transactions. Some of the exercises we look at today will be that we are acting for the seller or doing accounting for the seller. In this case, we're starting out, we are the buyer. And we are going to purchase $36,000 worth of merchandise from Shell Company. We bought it on account, and we've already talked about the payment terms idea. The payment terms here are 110 net 30 or 1% 10 net 30. What that means is If we pay within 10 days of the invoice date, we can take a 1% discount on the merchandise, and we will be looking at how we report that here in letter B, if we take the discount. And if we don't pay within the 10-day window, the full amount of the invoice or the net amount is due in 30 days. Because we're using a perpetual inventory system, when we buy inventory, we add it directly or immediately to the inventory account. And because we bought it on account, what that means is we haven't paid for it yet. And so we now have a liability, accounts payable to Shell Company. The book talks about, and you should definitely read about, if you haven't already in the book, about subsidiary ledgers. So we've seen that accounts payable starting in chapter 1. We've seen that many times at this point. But that dash Shell Company, what does that mean? Do we actually have a separate accounts payable just for that one vendor or one supplier? We definitely don't. That would be far too cumbersome in our accounting records. But what we have is what's called a subsidiary ledger that comes under accounts payable that provides the detail. So if we go to the subsidiary ledger, we would see a separate area or a separate accounting of what we owe Shell Company, all of the invoices, the due dates, so that we can keep track of that. So you should read about subsidiary ledgers in your textbook if you have not already. In letter B then, again, we did this together in class on Tuesday as well. In letter B, we're going to pay the invoice. We're going to pay within the discount period. So that means we paid within the 10 days of the invoice date. So when we pay that invoice, we need to whoops, sorry, I put that in the wrong spot. Let me put that up here. So when we pay the invoice, we want to show in our accounts payable records and on the subsidiary ledger for Shell Company that we no longer owe Shell Company. We are paying them what we owe them. So we want to remove the whole $36,000 from accounts payable, but we're not actually going to pay them. We're not actually going to pay them the full $36,000 because we're paying within that 10-day period. So we're going to take the 1% discount. We're going to pay 99% of that invoice, or $35,640. I just took the $36,000 value or cost of that invoice and multiplied by 99%, because we're only going to pay 99% of it. We're going to take the 1% discount, and that 1% discount then would be $360. So how do we report that? When we use a perpetual inventory system, we report that as a reduction in the value of our inventory. Okay. Inventory is an asset account, so if we credit that account, that means that we're reducing the value of that asset. Okay. We're going to report the inventory at only the 99% now as well. We now noticed that $9,000 worth of the inventory that we purchased is defective. And so we're going to return that merchandise. So when we return it, and we're returning it to Shell Company, it isn't specific about that. Oh, it says purchased in A, so it does tell us it's from this invoice. Now, we already paid for that merchandise. We already paid for that merchandise because we wanted to pay within the 10-day period, but we hadn't noticed at the time that we paid the invoice, we hadn't yet noticed that that merchandise was defective. It tells us that Shell Company gives us credit. So if this is a company with whom we do business routinely, you know, we might place an order with this company every week or once a month. We might, in that case, just accept the credit memo to apply toward our next invoice. And that's what we're doing here. If this was a company, and a company, God bless you, with whom we do business rarely, maybe we only order once a year or every 6 months, we probably wouldn't want to just hold on to that credit for another 6 months. Instead, we'd rather get our money back. And so we could have requested a refund. We could request that they send us a check. But in this case, we're happy, apparently, for at least for now, with just accepting the credit to our account. Now, we already took the 1% discount. So the original invoice amount was 9,000, but we didn't pay 9,000 for it. We only paid 99% of that, or 89.10. We took the $9,000 of invoiced merchandise multiplied by 99%. They're not going to refund to us more than what we actually paid, of course. And because we're returning that inventory to them and we use a perpetual inventory account, we need to remove that inventory from our records as well. If we used a periodic inventory system, parts of this would look different. The parts that would look different is everywhere you see a debit or a credit to the inventory account, we would use different accounts for that. Again, for our purposes in this chapter, you don't need to worry about that. I'm just pointing out to you how it would be different. If we only update our inventory periodically, we would not add the purchase or subtract the discounted amount or the return from our inventory. Our inventory under a periodic system, whatever it said at the beginning of the month, it's going to say that same amount throughout the entire month. And at the end of the period, we would make one adjustment to correct that or make that inventory value be whatever we have left at the end of the month. I'm going to ask you to try letter D and E on your own. These are similar to what we did in A and B. The difference is the terms now, for whatever reason, are net 30. So they aren't offering us the discount on this purchase. And I can guess as to why that might be, because we already have a credit of 80.
Would you be able to reopen my exercises?
I can, give me 1 second to do that. So go ahead and try these on your own. I'm going to pause the recording for a moment. Okay, so after pausing the recording, let's take a look at D and E. Excuse me. In D, it says we purchase merchandise on account. And I pointed out that they didn't offer the discount. And I assumed the reason they didn't offer a discount is because they already owed us about $9,000. And so we weren't actually going to pay this invoice. So when we buy the inventory, we would add that to the inventory account, debit to inventory for $5,000. And because we bought it on account, the credit would be to accounts payable and the subsidiary ledger for Shell Company. Now, it's off my screen because I had to clear my screen for a moment, but the previous entry from letter C showed that we had a credit coming from Shell Company of $89.10. And at this point, Shell refunded us the difference. So we spent $5,000 of that. They still owe us another $39.10, and they're going to send us a check for that amount. And that will make us even. It will clear out our accounts payable. On their side, it would clear up their accounts receivable as well. So any questions about what we've done so far? Yeah, so this terms of net 30 means that the full amount of the invoice is due in 30 days. Is that what you're asking? So up here in letter A, the first invoice, the terms were 110 net 30 or 1. And so the 1 means 1%. Sometimes you might read this 1% 10 net 30. And that means that if we pay the invoice in 10 days, we can take a 1% discount. And that's what we did. We paid it within 10 days. If we didn't pay it in the 10 days, we'd have up to 30 days to pay, but we'd have to pay the full amount, the whole 36,000. Without the discount. Yeah. Yeah. And as I explained on Tuesday, it's always in your best interest to take that discount because you're only paying 20 days early. I would pay on day 10, just me. I would pay on day 10, take the discount. You're paying 20 days early then. And a 1% return for only paying 20 days early is a really good return. A really good return on your investment. Even if you had to borrow that money, you're never going to be paying that kind of an interest rate on the money you borrow. So unless there's something really unusual happening in your company, if you're offered payment terms that involve a discount, you're better off to take that. So one other thing about those payment terms, these are negotiated or negotiable between the buyer and the seller. So if you have power, if you are a very good customer, a big customer of, in this case, Shell Company, then you can bargain with them for any of those terms. You can say, maybe I'd like a 2% discount, a 3% discount. So the percentage of the discount is negotiable. The days involved are also negotiable. So some companies might negotiate for terms of net 60 or net 90. They want more time to pay. So all of that, the percent of the discount, the time frame of the discount, the time frame of the net amount, all of that could be negotiated. And let's keep going. So in our first exercise, we had bought the merchandise on credit or on account. But that does not mean that we were using a credit card, a Visa or a MasterCard. Does not mean we were using a credit card to pay that. Instead, it means we owe the actual company. We didn't owe the bank that issued our credit card. In exercise 2, we're going to look at a different scenario. First, you should notice that for this exercise, we are now the seller. So I told you we'd be doing some exercises where we are the buyer, some that we are the seller. There might even be one where we do both sides, where we act as the seller and then as the buyer. And this is going to involve credit cards. And so this is going to be, certainly much more likely if you are a retailer and you're selling to the end user, to the consumer, that the consumer might pay using a credit card. You may or may not be aware of how credit cards work. So you may be aware of how credit cards work as the user of a credit card. So you get, if you pay off the balance, you get a grace period. As long as you're paying the full amount of the credit card, you don't pay any interest. But if you're carrying a balance, if you don't pay the full amount each period, each month, then you'll end up paying interest on that balance. What you may not be aware is that on the seller side, the vendors who accept credit cards are always paying a fee to the credit card companies for the privilege of being able to accept credit cards. And so looking at letter A, it says we sold merchandise for cash. Oh, sorry. Let me go down to letter C. Letter C, it says we sold merchandise to customers who used credit cards, Visa and MasterCard in this case. And so we sold it for $475,000. That was the revenue we received. But if we look down here to the final step of this exercise, the National Clearinghouse Credit Company billed us for a fee, and that fee would be based on a couple of different things. One, the total amount of the credit card billings. So you're going to pay a percentage of that. And companies that are larger companies and have larger amounts are going to generally pay a smaller fee. So if you're a very large company, the percentage that you pay for the fee is going to be lower. If you're a smaller company, that percentage is going to be higher. The percentage traditionally has ranged between, say, 2 and 6% that you have to pay to the credit card companies for the, again, the privilege or the fee for accepting credit cards. And so there's an additional expense associated with accepting credit cards that you don't have if your customers pay cash. So why would vendors, why would businesses accept credit cards rather than cash if it costs them more? Why would they do that? Yeah, exactly. Yeah, so they accept it because they know, and this is true statistically, if you have, if you accept credit cards, people are more likely to buy from you and the average order size increases. So even, and you guys probably already know all of this, even drive-throughs now accept credit cards where 10 years ago they did not. You had to have cash. If you were going to the Tim Hortons drive-through, you had to have cash to do that. Now they accept credit cards. Why? Because people will come use their service and they'll buy more from you if you accept credit cards than if you don't. It's a fact, and it's statistically accurate. So they've accepted the additional cost for taking credit cards because they know it will increase their sales overall. Okay. Clearly, there are some companies who do not accept credit cards. And they may have made that decision, at least in part, because it costs them more. And so it's not worth it to them. If you have store credit, which is the case we saw in the last exercise with Lily and buying from Shell Company on account, there's no extra fee associated with that, at least not directly. The risk is, and we'll talk about this in a couple more chapters when we get to the chapter called receivables, which I think is chapter 8. When we get to that chapter, we'll come back to this topic of why do companies extend credit? Why do they accept credit cards? Why do they extend store credit where you actually owe the store? And it's really the same concept, that they do it because they know that their sales were increased, but they also are accepting some risk. They're accepting some risk when they extend store credit. They're accepting some risk that you might not pay them. That risk is very, very small when they accept Visa, MasterCard, American Express, because the risk really transfers to the credit card company or the bank that issued the credit card that approved the sale. For the most part, that's true. So let's get started with this exercise then. Letter A says we sold merchandise for cash, $25,000. So what's one account that's going to be affected when we record that sale? What do we have that we didn't have before? Cash. So cash is an asset, normal debit balance. So to show we have more cash than we had before, we're going to debit our cash account for $25,000. Why do we have that cash? Because we made a sale, or we made a bunch of sales actually. And so we're going to increase the revenue account sales. So sales is a revenue account. Because we use a perpetual inventory system, when we sell merchandise, we have to record that we no longer have that merchandise, right? We sold it. So we have to remove that inventory, the merchandise, from our books. We charged our customers $25,000 for that merchandise, but we didn't pay $25,000 for it. If we did, we aren't very good business people because we didn't make any money on it. In fact, we would have lost money on it once we pay our selling and administrative expenses. And so the amount we remove from the inventory account is based on how much we paid for it. And that is the cost of goods sold. So we remove it from our balance sheet. It's no longer in our inventory account. And we move it onto the income statement. And it becomes part of cost of goods sold. It tells us in the directions to record the sale first. From a realistic standpoint, if we are using a perpetual inventory system, this is all going to be computerized and those entries happen simultaneously or at the same time. So we don't have to enter two separate entries. The computer does both of them together at the same time. It records the revenue and it also what we call relieves the inventory. It reduces our inventory. The only reason the exercise, the template tells us to do that is because if we put them in the opposite order, that's not what it's looking for. So it would mark it wrong. I would also guess they probably don't have the accounts yet. So we don't have cost of goods sold on that list. So it really forces you to do them in the order it expects. There's not a correct order, but there is an order that the program is programmed to expect to see and to mark correct. Go ahead and do the entry for part B on your own. This is mostly going to mirror part A, except we're now these sales are on account rather than cash sales. Okay, any questions about that one? Let's move on then to part C. So now in part C, we are selling merchandise to customers who use MasterCard and Visa. Let me just throw this up for a moment. So sales, if we use debit cards or bank cards, the cash is almost instantly available to the business. So that money is going to be reported almost instantly, practically instantly. And so we can record those as cash sales. But if they use credit cards, as I already showed you, as we get farther toward the end of the exercise, we are going to have a fee for that clearinghouse that is going to be a percentage, generally between 2 and 6% of the total sale. And again, that cash from that sale is going to be available almost immediately now for the seller to use that cash. So that process has gotten a bit streamlined over the past several years, maybe 10 years, so that there is no delay or very little delay from the time that the sale is made until that cash is available for the seller. So in letter C, we sold merchandise to customers who used MasterCard and Visa. So our excuse me, the credit side is going to be for the sale or the revenue amount. And the debit side, because we are going to receive that cash almost immediately, we can record this as a cash sale. But we know as we continue on in business that we are going to receive a bill for the fees associated with that. The cost of goods sold was $280,000. So just as we've done in the past two pieces, we need to reduce or relieve the inventory. And that inventory is based on the cost of the product to us. The recording of this transaction in letter D for American Express is really the same. It mirrors what happened in letter C. I just want to make a quick comment about American Express. 15, 20 years ago, American Express was only, if I can write this on my screen, American Express used to only be what is known as a T&E card or travel and entertainment. Up until 15 or so years ago, maybe a few more, 15 to 18 years ago, the American Express card did not have a credit card. It was not a credit card. It did not work the same way as Visa and MasterCard. American Express was primarily used as a business expense card. So if you worked for a business where you had to entertain clients or you did a lot of traveling for work, your workplace would have issued for you an American Express card, and the balance on that American Express card had to be paid every month. So there was no interest cost for an American Express card because the balance had to be paid every month. So that's the traditional American Express green card. They came out with the blue card, which is a credit card that does allow you to pay the balance over time with an interest cost associated with that. Many companies, as you may be aware, many companies will not accept American Express. And the reason that they don't accept American Express is because the fees on American Express are higher than on a Visa or MasterCard. And so the fees the company has to pay for accepting American Express is higher. And the reason that American Express did that is because they didn't, for a Visa or a MasterCard, the company's making money both from the person who uses the card to buy something because they are, if you don't pay it off, they're collecting an interest charge from you. Some cards, I'm assuming there are still some cards that do have an annual fee associated with them. And certainly historically that was the case. So they were also making money in that way, but then they'd make money from the vendors who accepted that credit card as well from those clearinghouse fees that we're talking about. So Visa and MasterCard are making money on both sides of the transaction, but American Express historically was not. They were only making money from the vendor side, and so they charge the vendors a higher percentage to accept that card, and that's why many companies choose not to accept American Express because of that additional cost. That's the only, I don't know exactly why the book chooses in this exercise to split out the American Express into a separate item like this, except that traditionally the card was different than a Visa or MasterCard. I like it because it does give me an opportunity to explain that in case you were not aware. And so for the American Express, our entries are going to look very similar, very much the same as what we did in the previous piece, so go ahead and complete that if you have not already. Recording the revenue as a cash sale, knowing that we are going to eventually have to pay the bill for the fees associated with accepting that card. And then reporting the expense, the cost of goods sold, the cost to us of that inventory, and removing it from our inventory account on the balance sheet. And then to finish up this exercise, letter E says, now we have to pay the bill. The bill comes from the National Clearinghouse Credit Company for $13,450, which is the service fee that we have to pay for processing all of those credit card sales. I'm just curious, I'm going to do a quick calculation here to see what percentage that is. So it's $13,450, and that's for the sales that were Visa, MasterCard, and American Express. And so that $13,450 represents about 2.5%, exactly, actually, 2.5% of the total sales. So that amount, $13,450, sounds like a pretty big number, but that's actually a lower percentage than most companies would likely see, knowing that the range is roughly 2 to 6% that they might end up paying. It may be that they're on the lower end because they are a larger company, $475,000 in sales. That's not a huge amount though, so it may be, it may not be a realistic number actually. So it would, I'm just suggesting it would likely be a little bit higher than that. And so we're going to pay that bill. So we're going to credit cash to show we used cash to pay the bill. And the debit is going to be to the credit card expense line on our income statement. So we show the full amount of the revenue from the sale, but then we have an additional expense reducing our net income. If these had all been cash sales, or if they'd been internal credit, store credit, if you will, if we billed the customers ourselves rather than going through a credit card company, we could have avoided those $13,450 in fees. But again, as we'll talk about more in the receivables chapter, it brings another set of issues with it. The biggest one of which is probably now we have to try to collect from our customer, and some of them may be unwilling or unable to pay when the bill comes due. Okay, any questions before we keep going? This makes sense? Hopefully some information there that you weren't aware of, hadn't thought about before. And we'll move on to number 3, which is sales promotions. Exercise 3. At the bottom of all its February sales receipts, Seifert Stores Incorporated printed $2 off coupons. The coupons could then be redeemed the next 2 months, March and April. Seifert Stores Incorporated accepts only cash, MasterCard, or Visa. Again, no American Express. We just talked about why that might be. During February, Seifert Stores completed the following selected transactions. They sold merchandise to Marcy Andrews with a list price of $175 that cost Seifert Stores Incorporated $80. Marcy presented a $5 off coupon, which she clipped out of the local newspaper, and she used her Visa card for the purchase. We've got a lot going on in this exercise. There are a bunch of different pieces to what happened here with Marcy. And so first, we need to report the sale, and then we're going to report the cost of that sale. So when we report the sale, we're going to report the full amount of the sale, $175, minus the $5 off coupon. Whoops, sorry, hang on. That on the wrong line. there we go. We're going to report the full amount of the sale. That's a revenue account, normal credit balance. And so we're going to report the full amount of the sale minus the coupon. And she paid with her Visa card. So as we saw in the last exercise, we're going to treat that as if it's a cash sale. But we realize at the same time that later on in the month, we're likely going to be getting a bill from that credit card clearinghouse that's going to include a little bit of that bill is going to be for our cost of accepting the Visa card. So we know that's coming. We also, because we use a perpetual inventory system, which we're using throughout this entire chapter, we also have to report that we no longer have that inventory and it has become part of cost of goods sold. So our cost of that inventory was $80. So the only thing new in this first part in letter A is that when Marcy used a coupon, we simply reduced the amount of the sale. Now, I want to point out that coupons like this there's a couple different ways that coupons might work. This is a store coupon that Seifert offered. If these were manufacturer coupons, so let's say it's on a product that was made by Procter & Gamble. Procter & Gamble might put out the coupons themselves. So in the Sunday newspaper, there are usually coupon inserts. Those coupons are not paid by the store, the value of those. Instead, the store redeems them. And in my example, Procter & Gamble is going to pay the store let's say it's $1 off coupon. Procter & Gamble is going to pay the store $1 for accepting that coupon, plus a tiny little handling charge. What we're talking about here are store coupons. In this exercise, it's pretty simple because the coupons were issued in February and then had to be redeemed in March and April. If this was the end of the year though, and they issued the coupons in December to be used in January or February, that creates a little bit more of an issue from an accounting standpoint, because the store knows that they have kind of a liability to accept those coupons, and they're going to lose a little bit on their sale. I'm not suggesting that you're going to see a separate line item on their balance sheet for outstanding coupons, but it does create a little bit more of an issue when they don't happen in the same accounting period, when they offer the coupons in one year and then redeem them in the next year. Taking that one step further, what if these were not coupons, but instead they were gift cards? So somebody actually already paid the store and bought, let's say, a $50 gift card. And the store now owes $50 worth of merchandise to whoever has that gift card. That's a very different issue. When they've already accepted the money up front but haven't earned it yet, that does create a liability for the store that must show up on their balance sheet. And if those cards, if they have an expiration date, the store doesn't get to keep that money after the expiration date. In fact, they're required to remit it to the state. Okay, so if those cards expire, they don't just get to keep that money. It's not theirs. They had a liability and they didn't, because the card wasn't used, that liability doesn't mean that the money belongs to that store. They would be required to send it to the state. If there's no expiration date, there's no issue. What makes this not a liability when they're offering coupons is that they didn't actually receive payment for that. So no cash has changed hands yet, and so it wouldn't need to be recorded, but they do need to be aware of that potential impact on their next period. Okay, any questions before we keep going? Okay, go ahead and try part B then on your own. So this is a sale to another customer, and this customer uses the $2 off coupon. Uses the $2 off coupon that he had it from the end or the bottom part of his receipt. So go ahead and record that. All right, so this is very strange. Because the sale the sale was for $50. Oh, wait, I'm sorry. I said, I misread it. I should have read the whole thing. So this is in February. He gets my apologies. He buys the merchandise and receives the $2 off coupon. He wasn't using the $2 off coupon, which is, I think, what I said. I should have just read it from the screen. So he still paid $50. That's why I was getting stuck. So he still paid $50, but now he has that $2 off coupon that he may use in the future. So, whoops, our first individual, Marcy, actually used a coupon. Chris Johnson was just provided with a coupon that he can use in the future. So of those $2 off coupons that are printed at the bottom of the receipts, do you think they all get redeemed? No, they definitely don't. They definitely don't. And that's going to come up in our next exercise here, our next part of this exercise. So in letter B, we reported the full amount of the sale because he didn't actually use the coupon. It wasn't eligible to be used on February 18th. Everybody good so far? Okay, let's look at letter C. Journalize the liability, if any, on February 28th for the coupons Seifert stores printed in February. And it gives us a bunch of information about how much they sold, how many receipts that was, how much the merchandise cost. Then they estimated that what percentage of those, so I said, they don't all get used. They estimate that only 15% of those will actually be used. So I already suggested if this was in the same accounting period, we wouldn't have to record a liability for them, because by the time the coupons expired, we'd still be in that same year. From my viewpoint, I don't think they would make the entry that's listed here in Part C unless they were closing their books and reporting to, maybe their quarterly statements. February is not the end of the quarter unless they use something other than the calendar year. However, we are going to do the calculation here and see what this would look like if it was at the end of the period and they needed to report that. Okay, so let's figure out, let me put this on the screen. Let's figure out how much they might lose in sales if their estimates are correct. So the sales were there were 12,500 printed sales receipts. Sorry, 12,500,000. That seems super high. That means their average sale was only $2. Okay, that's just really strange. Because their average sale was $2 and they printed $2 off coupons on each one of those. So basically they're telling them you can come back and get exactly the same thing again for free. I think whoever wrote this probably didn't really mean for it to be quite so high. 12.5 million sales receipts for 25 million in merchandise. I can't think of a single type of store that would have an average sale of $2, but it's what they're telling us, so we're going to go with that. So in other words, they printed $25 million worth of coupons. Again, that's a really high number. That's their whole sales for the month of February. That's a super high number. And now that I'm looking at those numbers, that alone could be the reason that they need to record the entry that we're about to do, because this is a huge number. This is what we would call a material amount. So we've talked about that term material before. Material means it's big enough to matter. It's big enough to make a difference. If a person looking at their financial statements, trying to make some decision about the company, if they knew this information, it might lead them to a different decision than if they didn't know this about the company. And so this is a huge number. 12,500 receipts with each with a $2 off coupon. So they issued $25 million worth of coupons, and they expect 15% of them to be redeemed. That's $3,750,000. And that is a very, very large number for a company that only had $12 million in sales. So that's making me backtrack on everything I was saying about probably wouldn't need to record it because it's not even, it's in the same accounting period if we're using January to March as our first quarter. But this number is so large, I think I would change my opinion about whether it needs to be reported or not, because that's huge. So $3,750,000. And we are going to report that as a reduction in our sales. So we're reducing the revenue sales. Can't move that green part out of the way. And increasing our liability that we're going to have to accept and redeem those coupons. God bless you. So those are related to the February sales. I'm really sticking with, we would not need to record this if it were not such a very large number, but this is definitely a big number. It certainly could lead someone to a different understanding or decision about how this company did in the month of February. And maybe that's why they put in such a very large and really unreasonable number. Do you really think that a company that had 12 or 25 million in sales would print coupons for $25 million from those sales? That doesn't even make sense. Okay, any questions about that exercise? Okay, with where that number came from, why they need to report it, because it definitely is a material amount. But certainly, and I think everybody who answered agreed that it's not likely that all of those coupons would actually be redeemed in that March to April time period. 15% might be a bit low, but where would that number come from? If they've done promotions like this in the past, they would base it on their prior experience. It is that 15% is an estimate, and so it may not be 100% accurate. Likely it's not 100% accurate. But the reason it's important that we put it in there, because it's such a large and material amount, is because it really would change the results reported by Seifert stores for the month of February. Let's move on then to exercise 4, if no one has any questions. So now we're looking at a company that has accepted a return from a customer and offered them a refund on what they had purchased. On December 28th, 2023, Silverman Enterprises sold $18,500 of merchandise to Beasley Company. The terms were net 30, so Beasley had 30 days to pay. The cost of the goods sold was $11,200. On December 31st, 2023, so just 3 days later, Silverman, who was the seller, prepared its adjusting entries, yearly financial statements, and closing entries. On January 3rd, 2024, so just 3 more days later, it's only about a week after the original sale, Silverman Enterprises issued Beasley Company a credit memo for returned merchandise. The invoice amount of the returned merchandise was $4,000, and the merchandise originally cost Silverman Enterprises $23.50. First, we're asked to journalize the entries by Silverman Enterprises to record the sale. I just want to point out, as I read through all of this, we spent some time last class talking about the accounting cycle. And I told you that those closing entries at the end of the year, this is their yearly year-end close. Those closing entries would not have been done on December 31st. They likely wouldn't have been done until at least the middle of February, at least, because you wouldn't do those closing entries until your financial statements were audited. So there's zero chance they actually happened on December 31st, although they would be dated December 31st. They would not be entered right at the end of the year like that. There's no chance that happened. So how do we report the sale? This is nothing new. At the time we made the sale, we had no idea that the buyer was going to return a bunch of the merchandise. So we would record the sale exactly the same way that we have been doing all through this chapter. They bought it on credit. We report our sale. We report the cost of goods sold, and we reduce or relieve our inventory. So go ahead and do that. And those 2 entries. Okay, so nothing new there in part A, but any questions about that? Part B asks us to journalize the entries by Silverman Enterprises to record the return of the merchandise. So Beasley had not paid us yet. The terms were net 30, and this was only about 6 days later. So it's highly unlikely that they would have paid us already at the time that they returned the merchandise. And it does tell us that we issued a credit memo. So that credit memo would go against the amount that they already owed us. So they owed us 18,500. We issue them a credit memo for the $4,000 return. And when they pay the invoice, they would pay us just the difference, the 14,500 that would be left. But let's journalize the entries for accepting that return. The first part is a debit to customer refunds payable. So let's finish these and then I'll talk a little bit more about that. And then the credit would be to accounts receivable. The customer, Beasley, no longer owes us that $4,000. I'm going to talk about this customer refunds payable in just a moment, as soon as we finish this entry. If there was nothing wrong with the merchandise, we would simply add it back into our inventory and debit estimated returns inventory. And I'll talk about that in the same context as the customer refunds payable. But let's see what the cost of that merchandise was, $23.50. Give me 1 second here. Okay. So let me talk about what those customer refunds payable and estimated returns inventory accounts are and how we would use them. Hopefully it's clear though why we are going to credit accounts receivable and the subsidiary ledger Beasley Company, because they don't owe us that anymore. They return the merchandise. They don't owe us for it anymore. And also, hopefully it's clear why we debit inventory. We debit the inventory as long as there's nothing wrong with that merchandise, we're going to add it back to the inventory account. If there's something wrong with it, if it's defective, it becomes an expense or a cost for us, because we're not going to put it back into inventory if we can't sell it. If it's damaged or spoiled, defective in some way, we would not add it back to the inventory. But let me talk now about those other two accounts so that you can understand why we use those, the payable and the estimated customer returns. I don't think I need to be on that page. Let me go to this page. Okay. So as long as we allow customers to return product, we have to take that into account. We've talked about, starting in chapter 3, the concept of the matching principle. So the matching principle says we record revenues when we've earned them. And we talked about that 4-step test. We need to meet all 4 steps. And once we've met those 4 steps, we can record the revenue. In fact, we must record the revenue in that period. So in case you don't remember, the 4 steps are, we have to have an agreement between the buyer and the seller. The price has to be fixed or determinable. In other words, we know they mount. We have to have delivered the product or performed the service. And we have to have reasonable assurance of collectability. So if all 4 of those things are true, then we're going to record the revenue. But the second step, the second part of the matching principle is, what do we match against those revenues? And what goes against those revenues is all of the costs that helped us to generate those revenues. If we allow customers to return stuff up to us, that's a potential cost, right? We may not have really earned all those revenues for keeps until that return period. So maybe we allow them to return things for up to 30 days, let's say. So that's going to create a liability for us in the future to pay them back if they return that merchandise. Let's say, just for sake of example, it didn't say this in the exercise, but let's just pretend it said that customers could return merchandise for up to 30 days. So that means we only need to keep track of how much did we sell in the past 30 days, how much of that might possibly be returned. How would we know that? How would we know how much to expect to have returned to us? Well, we'd look at what's happened in the past. On average, I don't know, maybe 2% of our product gets returned or something like that. We're going to look at the history and base our future estimates on what's happened in the past. But if we allow people to return product, if it's not a, what do I want to say? When it's, what's it called when you agree to take it at, like you're selling it as is? Is there a word for that? If we don't allow them to return it, we don't have to worry about any of this. But as long as we allow them to return it for some period of time, we have to take that into account. And we have to estimate how much they might return in the future. And we report the cost of that at the time of the sale. This same concept is going to come up in the receivables chapter when we talk about the idea that someone, when we sell to someone on credit, they might not pay us. That's a potential future cost. We have to take that into account. There's going to be another adjusting entry to recognize on the asset side, though, that if we accept returns, we're going to have that inventory returned to us. And so these are kind of matching entries. However, the dollar amounts are going to be different because the customer refunds payable is going to be based on what we charge our customers. And the estimated returns inventory is going to be based on our cost. So with that in mind, let me go back to what we did here. When we debited customer refunds payable, what we are really doing is using up part or reducing in part that liability. We knew that some of our customers might return the merchandise. And so we set up this payable, a liability that we have to accept their refund, their return. And now that Beasley did return some stuff, that reduces our future liability to other companies. Okay, we didn't know Beasley was going to return inventory. When we set up that liability, we didn't know who was going to return their purchase, but we had a good idea that some of our customers might do that. That customer refunds payable then is an estimate based on what we think might be returned in the future, which would be based on what have we had happened in the past. And if we're a brand new company, this is even more complicated because we don't have that history to look at. So we're going to give it our best effort to estimate how much might be returned to us. And we're likely to be less accurate when we don't have that history. The estimated returns inventory is an asset. So inventory, we already know, is a current asset. It shows up on our balance sheet as an asset. The estimated returns inventory is, I'm just going to say it's imaginary. It's not actual inventory that we have, but it is potential inventory that we will have in the future when a customer returns product to us. So the one part that bothers me a little bit about this exercise is we can't see in this exercise where that customer refunds payable liability was set up and where the estimated returns inventory asset was set up. Those would have been accomplished through adjusting entries at the end of, in this case, January. Sorry, at the end of December. That sale took place in December. So at the end of December. We don't see that here because we don't make an entry just based on Beasley's purchase from us. We make the entry based on all of our sales in the month of December. So there would have been an adjusting entry at the end of December to reflect the likelihood that some of our customers might return what they purchased from us. The whole reason we do that is to make sure that our income statement for December accurately reflects the revenues that we earned, but also the costs that go into generating those revenues. Questions about where we are so far? Again, it's a little bit more complicated because we don't see those adjusting entries, and we haven't in chapter 3, when we looked at a bunch of different types of adjusting entries, this is not one we had seen before. But certainly it happens. Certainly it happens when you are selling merchandise to customers that some of them might decide they want to return it for any number of reasons. Wasn't the right color. It's not what they thought it looked like in the picture on the website, whatever. Letter C says journalize the entry to record the receipt of the amount due by Beasley Company on January 7th. So originally they purchased $18,500 worth of merchandise, but then we issued a credit memo for $4,000. So how much are they actually going to pay us on January 7th? $14,500. The original invoice was for $18,500, and then we issued them a credit memo for $4,000. So they only owe us and therefore only pay us $14,500. We then report that we have that cash and that they no longer owe us. We remove that total from the accounts receivable. So if we were to put a T account on the screen now for that accounts receivable, we would have seen a debit for the original sale of $18,500, then a credit when they returned the merchandise, and then another credit when they paid the balance. And so in our records, we now reflect they no longer owe us anything more. Anybody with questions? Look at one last exercise for today, and then we'll be in good position to finish up the chapter on Tuesday. So in this exercise, we have showcase companies entries for Balboa. Give me 1 second here. In the next exercise, I just want you to see this. In the next exercise, we are going to look at these same transactions, but from the opposite side. Okay, so in exercise 5, we're looking at sales related transactions when we are the seller. When we come back on Tuesday, we'll look at the same transactions, but from the buyer side, the purchase related transactions. Showcase Company, a furniture wholesaler, sells merchandise to Balboa Company on account. The total amount of the invoice was $254,500, and the terms were net 30. The cost of goods sold is $152,700. Showcase then issues a credit memo for $30,000 of merchandise that was returned before Balboa paid the original invoice. And the cost of that merchandise they returned was $17,500. So first, we're going to journalize the sale, including cost of goods sold. I'm going to ask you to do that on your own because that is not anything we haven't already done. Remember, we are the seller. And we're using a perpetual inventory system. Everybody okay with part A? All right, let's look at B then. And in B, we're going to be using that same concept of the customer returns payable and the estimated return inventory that we just finished in the previous exercise. So we're going to issue a credit memo for the $30,000 worth of merchandise returned. That's how much we had charged Balboa, but they haven't paid us for it yet. So we're going to remove that from accounts receivable. And we are going to we're going to debit customer returns payable, customer refunds payable. Why are we crediting that? Why are we debiting that liability account? Because when we close our books, we're going to do an adjusting entry for all of the refunds we think we might need to offer or to pay to our customers. And this is going to be just one of them. We're going to reduce our liability because we already paid Balboa back. And then the other part is that we receive that merchandise with a cost of $17,500. So we're going to add that back to our inventory. And we're going to reduce the estimated returns inventory, which is an asset for us. So we're basically removing some of that estimated returns and adding it to actual inventory. They now have returned that product. And we knew we had estimated, or we would estimate at the end of the period, that some of our customers would return inventory. Now we know that one of the customers returning inventory is Balboa. And the last step then is to journalize the receipt of the check for the amount due. So how much do they owe us? Originally, they owed us $254,500, but we gave them a credit memo for $30,000. So how much do they owe us now? They don't owe us the $254. Now they just owe us $224,500. And they're paying us, so we're receiving cash and they no longer owe us. So we're going to credit accounts receivable. We have a bit of time left, so I think we're going to just go ahead to exercise 6 before we lose track of the information here. You don't have to start from scratch on Tuesday. Does anyone have any questions on this? So the seller side of the transactions. I think it will be beneficial to right away see the buyer side of these same transactions. So let's use our time wisely and we'll go to exercise 6. Same information, only we are now the purchaser. So we're now recording for Balboa when they purchase the inventory using a perpetual inventory system. They now have inventory valued at $254,500. Remember, Showcase had it on their books for just $152,700. But Balboa is going to carry it on their books at what they paid for it. It's somewhat like a value added transaction. And they bought it on credit, so now we're going to report that payable. So when Showcase reported the sale, remember that was a 2-step process to record the revenue and receivable and to remove it from inventory. But for Balboa, it's just one entry to record. They now have that inventory available. Same thing when they return the merchandise, they are going to reflect that they no longer have to pay for it. reducing or relieving that accounts payable. But they also have to remove it from their inventory. They don't have that anymore. And again, a one-step process for Balboa, where it was a two-step process for the seller, the original seller. And now when they pay that invoice, how much do they owe? And well, that number's different. I'm just want to point this out. There's actually, what I'm going to suggest is a mistake. So that credit memo was for 30,000, so that they should have used 30,000 in the next exercise as well, but they didn't. So that's actually oh, there it is. Hang on, they did. It's right there. They did tell us the credit memo was for 30,000. It must have been scrolled down too far or something. So I just read the cost of the merchandise, and I read that as the cost to Balboa, but that was showcase cost. The cost to Balboa was 30,000. This cost of merchandise returned referred to Showcase's cost, not Balboa's cost. So now the numbers match. I thought they were changing something on us. So they originally owed 254,500, but they got a credit memo for 30,000. So just like in the previous exercise, now that I read that correctly, the amount that they are actually going to pay is the 224,500, same as in the previous exercise. They did not change something on us. Okay, so that's where we are going to stop for today. So we've looked at recording purchases, sales, returns, paying invoices with discounts, paying invoices for cash, using credit cards, lots of different merchandising related transactions. Any questions about anything we've talked about up to this point? Kind of seen it from all angles. All right, so we'll stop there for today. On Tuesday, then we will pick up with exercise 7.